Tesla has always been seen as the trailblazer of electric cars and cutting-edge tech, but lately, things aren't looking quite so unstoppable. For the first time in years, the company is hitting some serious bumps. Think revenue drops, tough competition, and big changes in strategy. So, what's actually happening beneath all the flashy headlines? In this video, we'll unpack the real story behind Tesla's recent struggles and what it means for the future of both the company and the industry. Let's dive in and decode the economics behind these headlines. Tesla's 2025 financial results were a big deal. For the first time ever, the company saw its annual revenue go down instead of up. Revenue dropped to $94.8 billion, a 3% dip from the previous year. The main culprits? Fewer cars sold and a cutback in regulatory credits, which are basically government incentives for making electric vehicles. This isn't just a blip. Tesla's profits also took a hit, plunging 61% in the fourth quarter. For investors, this reversal is a wake-up call, raising questions about whether Tesla's growth story is running out of steam. Tesla used to be the king of electric vehicles, but lately, things have changed. Vehicle sales have dropped, and Chinese automaker BYD has swooped in to claim the top spot. This shift isn't just about bragging rights. It's a sign that the EV market is getting more competitive, with new players offering fresh options and sometimes better prices. For Tesla, losing its crown means rethinking how it stands out, especially as rivals like BYD keep raising the bar. We'll dig into how this rivalry is reshaping Tesla's place in the global EV race. Tesla has officially pulled the plug on its Model S sedan and Model X SUV, two vehicles that once defined the brand's luxury electric lineup. So why the sudden shift? The company says it's all about making room for a new focus, robotics and autonomous tech. By repurposing the Fremont factory, Tesla aims to ramp up production of its Optimus humanoid robots, betting big on a future that's less about cars and more about cutting-edge automation. This move signals a major pivot for Tesla as it tries to stay ahead in a rapidly changing tech landscape. While Tesla's car sales and profits have taken a hit, their energy storage business is bucking the trend. This segment includes products like battery packs for homes, businesses, and even utility companies, helping store renewable energy for when it's needed most. Demand for reliable energy storage keeps growing as more people and industries shift towards solar and wind power. Unlike the crowded electric vehicle market, Tesla's energy storage solutions are carving out a strong niche. So, even as the rest of the company faces tough times, this part of the business is still shining. Tesla's stock has been on a roller coaster lately. When controversies hit, like leadership shakeups or public backlash, the share price dropped sharply, at one point falling into the 200s. But as the dust settled and some investor confidence returned, the stock bounced back, now trading around $417. Even with revenue declines and fierce competition, the market seems to be betting on Tesla's future in tech and robotics. It's a classic case of how investor optimism can sometimes outweigh the tough headlines and financial setbacks. So, what's the big deal about EV tax credits? Basically, these government incentives made electric cars cheaper for buyers, which helped boost sales for companies like Tesla. When the US decided to pull the plug on these credits, suddenly Tesla's cost more out of pocket and fewer people were lining up to buy them. That drop in demand meant less revenue for Tesla, and it wasn't just them. Other EV makers felt the sting too. Removing these credits didn't just affect one company, it sent ripples through the whole electric vehicle market, making growth a lot tougher for everyone. Tesla's financials are looking pretty rough lately. Net income, which is basically the company's profit after all expenses, fell by a whopping 61%. At the same time, operating expenses, think salaries, research, and day-to-day costs, shot up nearly 40%. So what does that mean in plain English? Tesla is spending way more to keep the business running, but making a lot less money. That's not a great combo for any company, especially one that's used to being a Wall Street favorite. So, is Tesla just another car company, or does it still deserve that tech company label? The debate really heats up when you look at its valuation. Tesla's stock trades at levels way above traditional automakers, all because investors believe it's more than just cars. The real bet is on things like autonomous driving, AI, and robotics, which Elon Musk claims will shape Tesla's future. But here's the catch. Most of these innovations are still in the works, not actually making money yet. Investors are basically gambling that Tesla's tech dreams will pay off big, even though the company's current profits look a lot more like those of a regular car maker. Let's talk about Tesla's price-to-earnings ratio, or PE ratio, which is basically how much investors are willing to pay for each dollar of profit the company makes. For most car companies, this number is pretty low because the industry is competitive and margins are tight. But Tesla's PE ratio is sky-high, almost 300, while traditional automakers usually sit in the single digits or teens. This means Wall Street is betting big on Tesla's future growth, not just its current profits. The catch? Such a high PE can signal huge expectations, and if Tesla doesn't deliver, those numbers might not add up in the long run. So Elon Musk is shifting gears and telling everyone that Tesla's future isn't about cars anymore. It's about robots, artificial intelligence, and self-driving tech. This big pivot comes right as Tesla's car sales and profits are dropping, and competition is heating up. The company is betting that investing billions in robotics and AI will open up new markets and boost its value, even as its traditional business slows down. But here's the thing. Most of these new ventures are still in the early stages, with no proven track record or widespread adoption. We'll unpack what this move means for Tesla, and whether it's a bold leap forward or just a flashy distraction from the car business struggles. Optimus is Tesla's humanoid robot, and lately, it's grabbed the spotlight as Musk's new big idea for the company's future. Unlike Tesla's cars, Optimus isn't something you can buy yet. It's more of a promise than a product, with only a few factory demos and no real-world sales. Musk claims these robots could eventually handle everything from household chores to complex tasks, making them a game-changer for both businesses and everyday life. The idea is that Optimus could even become the main source of Tesla's value, which is a pretty bold claim considering where things stand today. So why all the hype? It's about shifting Tesla's story from cars to cutting-edge tech, hoping investors see the company as more than just an automaker. Optimus, Tesla's humanoid robot, is getting a lot of buzz. But let's keep it real. Right now, Optimus isn't something you can buy, and there's no price tag or actual sales to speak of. The robot hasn't been rolled out for real-world use, aside from a few controlled demos and factory tests. So, while the idea sounds futuristic, it's mostly just a promise for now, not a product you'll see in homes or businesses anytime soon. So the pitch is that robots like Tesla's Optimus could one day replace human labor and even help solve global poverty. That's a pretty ambitious vision, but it's not as simple as just building a robot and calling it a day. For this to actually happen, Tesla would need to overcome huge challenges, like gaining regulatory approval, earning public trust, and proving these robots are safe and reliable. Plus, the economics have to make sense for businesses and households. It's a long road ahead, and right now, Optimus is more of a future promise than a real-world solution. Robotics is a crowded field, and Tesla isn't the only player aiming for the top spot. Chinese companies, in particular, are making big moves and have a head start in both manufacturing and innovation. That means Tesla can't simply rely on its brand or past success to dominate this new market. Winning here will require serious breakthroughs, smart strategy, and a lot of trust from regulators and customers. So, while the idea of humanoid robots sounds exciting, the reality is that Tesla faces tough competition and plenty of hurdles before it can claim victory. Tesla recently pulled the plug on its Model S sedan and Model X SUV, and that move isn't just about cutting unpopular cars. Instead, it's being framed as a bold pivot toward robotics and autonomous tech. The Fremont factory, which used to crank out these high-end vehicles, is now getting a makeover to produce Tesla's Optimus humanoid robots. This shift signals that Tesla wants to be seen less as a car company and more as a tech innovator. By freeing up resources and space, Tesla is betting big on a future where robots, not cars, are the main event. Autonomous driving is one of Tesla's headline promises, but let's get real about where things stand. Right now, Tesla's so-called full self-driving system is actually just advanced driver assistance. It still needs a human behind the wheel at all times. Unlike some competitors, Tesla hasn't launched fully driverless ride services, and its tech isn't approved for unsupervised use anywhere. So, While the marketing might sound futuristic, the reality is that true autonomy is still a work in progress for Tesla. Tesla's so-called full self-driving might sound futuristic, but in reality, it's still just a driver assistance feature. That means you can't kick back and let the car do all the work. You have to keep your hands on the wheel and your eyes on the road at all times. The system can help with things like lane changes and parking, but it's not approved for unsupervised driving anywhere. So, for everyday drivers, it's more like having a helpful co-pilot than a robot chauffeur. The dream of fully autonomous cars is still a work in progress, and for now, you're definitely still in charge behind the wheel. Tesla's autonomous ride tests in Austin might sound futuristic, but they're actually pretty limited. These cars still need a human supervisor, so they're not truly driving themselves, at least not in the way most people imagine. Real autonomy means a vehicle can operate without anyone behind the wheel, handling all situations on its own. For example, Waymo already runs fully driverless ride-hailing services in several U.S. cities, where the company, not the passenger, is responsible for the car's actions. So, while Tesla's tests are a step forward, they're still a far cry from the kind of hands-off, fully autonomous experience that's already happening elsewhere. Waymo, which is owned by Google, has taken a big leap forward in the world of autonomous vehicles. Unlike Tesla, Waymo actually operates fully driverless ride-hailing services in cities like Phoenix, San Francisco, Los Angeles, and Austin. These cars don't need a human behind the wheel, and Waymo assumes responsibility for the autonomous system itself. Tesla's approach, on the other hand, still requires constant human supervision and isn't approved for unsupervised operation anywhere. So while Tesla talks a lot about autonomy, Waymo is already delivering it in the real world. Tesla's big pitch to investors is that autonomous technology will take off fast, but that's a pretty bold assumption. Scaling up self-driving cars and robots isn't just about the tech. It means convincing regulators, insurers, and everyday people that these systems are safe and reliable. Right now, full autonomy isn't approved for unsupervised use anywhere, and most consumers aren't ready to hand over their car keys to a robot. Betting on this rapid adoption skips over some serious roadblocks, making it a risky move for anyone banking on Tesla's future growth. Let's break down why these hurdles matter and what they could mean for the company's next chapter. Turning your Tesla into a robo-taxi sounds futuristic, but it's not as simple as just flipping a switch. Most people aren't keen on letting strangers use their personal car, especially when it comes to wear and tear or privacy concerns. Plus, there are big hurdles like insurance, regulations, and trust. Would you really want your car driving itself around town without you? Even if the technology gets there, convincing owners to join the robotaxi revolution is a whole different challenge. So, while the idea is cool, it's a leap to think everyone will jump on board. Elon Musk's political moves and outspoken comments have stirred up quite a bit of controversy, and it's had a real impact on how people view Tesla. Over the past year, protests have popped up at Tesla showrooms and charging stations, both in the US and abroad. Musk's presence in political debates and his activity on social media have tied his personal reputation closely to the Tesla brand. As a result, some segments of the market that once saw Tesla as innovative and aspirational now associate it with controversy and divisive ideology. This shift in public perception is making it harder for Tesla to appeal to a broad audience, and it's starting to show in the company's performance. Elon Musk's activity on social media isn't just about tweets. It's become a major part of Tesla's public image. When the CEO regularly wades into political debates and shares polarizing opinions, it can turn off whole groups of potential buyers. This shift has sparked protests and boycotts, with some consumers now associating Tesla more with controversy than innovation. As a result, segments of the market that once saw Tesla as aspirational are starting to look elsewhere, and that's showing up in the company's sales numbers. The brand's reputation is now tightly linked to Musk's online persona, making every post a potential risk for Tesla's bottom line. Tesla used to be the cool, futuristic brand everyone wanted a piece of, but lately, that shine has faded. Elon Musk's high-profile antics and controversial statements have made the company less appealing to some buyers, especially those who value stability and trust. When a brand loses its broad appeal, it can start to see fewer sales and less support from regulators, which hits the bottom line hard. This shift isn't just about reputation, it's about real dollars and cents, as entire segments of the market turn away. So, let's break down how public perception and trust can make or break a company's financial health. So, even with Tesla's profits dropping, competitors like BYD taking the lead, and Elon Musk stirring up controversy, the company's stock price hasn't crashed. In fact, shares have bounced back from last year's lows and are still trading at a premium. Investors seem to believe in Tesla's future as a tech and robotics powerhouse, not just a car company. The promise of innovation, like robotaxis and humanoid robots, keeps investor confidence high, even if the reality hasn't caught up yet. It's a classic case of betting on potential rather than what's happening right now. Despite all the headlines and controversies, investors seem convinced that Tesla's promise of cutting-edge technology will eventually eclipse any negative press or brand backlash. But betting on tech to solve everything is a gamble, especially when the company's actual products and profits are under pressure. If public trust erodes or regulatory hurdles get tougher, those futuristic ambitions might not be enough to keep Tesla's value soaring. We'll break down why relying on a tech narrative alone can be risky and what could happen if reality doesn't match the hype. Tesla's story is shifting fast, and while the company talks a big game about robots and autonomous tech, the reality hasn't quite caught up yet. Investors and fans are being asked to believe in a future that's still mostly theoretical, with plenty of hurdles left to clear. Keep an eye on whether Tesla can actually deliver on its robotics ambitions, and watch how the competition and public perception shape its next moves. The gap between what's promised and what's real is bigger than ever, so the next few years will be crucial for seeing if Tesla's bets pay off or fizzle out.